Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. I'm joined by Nader Naeimi, who's the Head of Dynamic Markets and Portfolio Manager at AMP. Nader, welcome.
Thanks, Alex. Thanks for having me.
Oh, look, it's always a pleasure. I thought, the way to probably kick off this conversation today is to really get a bit of a background on what actually got you into markets in the first place. What was the driving factor? Is this something that you always wanted to do?
Yeah, Alex, I was always a mathematical kind of guy. When I did my school, I liked maths. And so, as I was studying, my maths teacher suggested I do actuarial studies. And I kind of looked into it. And that's how I started my, university degree in a very kind of a quantitative discipline. And my first job, in fact, was a quant analyst. And so I spent a lot of time modeling markets. So I thought, coming out of university, I thought you're going to have the silver bullet. I've studied all the actuarial studies, all the maths, and I should be able to model the market. So I spent a lot of time with stochastic models and, some way to forecast the market. And, after 5 years, I just realized markets are a lot more than just, being able to summarize them into statistics, right? So that was I kind of had the foundation, which was the science part. And the next phase of my career really went on to the art part, which was understanding what drives market, what makes the market, right? What makes the market? Obviously, people react to different news, and everybody's got different time horizons. People play different games, and at the same time, having that fundamental or quantitative lens is important. But again, so how markets perform, how they do it, and what drives markets fascinated me. And I spent many years trading markets and realizing that, I couldn't just use fundamentals. So what happens with technical sentiment are important. And so anyway, I just developed this passion, the love of markets. And it's just, I'm very fortunate because I've been able to do a role that I'm excited to get up and do it every day. Obviously, there are some really, really stressful days. You wake up shaking, worrying about what happened in the US overnight. And I've gone through plenty of cycles. But that's part of the game, right? But it's that no 2 days are the same. And that's what excites me. And it's all about how people behave.
Let's go back to your comments around sort of this art and science trade-off. And we see a lot of people that come into the markets or that are traders who either in basically the feeling camp and they really rely on sentiment and technicals. And then you've got the other people that are very much the scientific crew that really look to trying to understand a model that can work out the market. How do you blend those two? How do you blend the art and science? Which?
Yeah, it's very important. Exactly right. And there is a balance, and you got to blend the two. And at the heart of it, the fundamental law for active management is that there's uncertainty. Future is uncertain, right? If we knew the future, we wouldn't be able to call what we do investing, right? Because the whole point of investing is just because the future is uncertain. And as Yogi Berra called it, the future ain't what it used to be. So basically, we got to have to, as portfolio managers and investors, we have to be able to deal with risk and uncertainties. And I think, and that's what the science and art differentiate. So when you look at risk, risk is obviously very important. So risk is about the quantifiable probabilities and outcomes, right? Mm-hmm. So this is the science part. This is a science we can sort of quantify, chances of, for example, rain. But then there is uncertainty around that. And the uncertainty is about the degree of belief and subjectivity, right? So, for example, just give you an example. We know COVID impact on the supply or availability of toilet paper. Paper will be very, you probably wouldn't be even 1%, right? So if you just actually quantify that as a risk of COVID impacting supply of toilet papers, you wouldn't give that a much high probability. But that's the subjectivity around the uncertainty that makes difference, right? And that's art. And a lot of people resort to the survival, the way we are built to survive. So if, for example, if everyone else rushes out for toilet papers, you join, even though you know the probability of that is low. So you can see that the risk part is stuff that we can quantify, we can put probabilities on it. The uncertainty is the uncertainty is the eye of beholder, right? So that's the art part. The stuff that you got to feel. And in the world, you have some things like accountable, others you just have to feel out, right? In other words, gathering information in science, filtering out the noise is an art. And that's very important. So you can put a percentage on it. It's very hard. I mean, obviously, there's so many different strategies. Some are purely quantitative, some more discretionary. But I think a kind of a 50-50 approach makes a lot of sense because, but for example, you look at a very, very basic stock analyst, right? They look at net present value, right? Net present value is a science, but identifying the trust and passion of a CEO is an art. Right. So you got to be able to bring the two together. And we just the way I look at it is just we can measuring what has worked in the past is science. Right? We all do. Everyone does it. There's a lot of insights, but the foresight, which is the art part, is understanding why things could be different, is an art. Right. So
that art is really, really interesting because we're started to learn, particularly around the Trump presidency, the power of narratives and the power of the media. How much is art now almost being convoluted by media out there, and then media then drives these narratives that then ultimately drives the market to move. And particularly with the amount of retail players that have become accustomed to trading and investing, how much has that changed the game?
Absolutely, it has. I mean, in a way, it really depends on the time horizon. So what we have now, we have a world that is just saturated with insights. Insights being real, true information, but also fake information. Some people get insights based on fake, data, information, some real. But there's a lot of insights. We can't. That's the thing. That's what we have tried. Everybody just out there on the screens getting the information, and there's a lot of insights. But at the same time, there is a profound lack of foresight because everybody, as you said, everybody reacts to the same thing, and everybody just basically. And you see big trends in markets. So I mean, as a trend following strategies that just close their eyes and follow a trend, it probably it has worked. But the problem is, some of these things go way too extreme, and we've seen historically markets are inefficient. The reason markets are inefficient is just when everybody ends up doing the same thing at the same time. And so it just has the perception of being safe because everyone else is doing it. But as we know, we've said before, liquid is a coward, right? It's a good saying. Liquid is a coward because it disappears at the first sign of trouble. And that's the thing. So when the traffic is one way, it's okay. We can react to news. Everyone does the same thing. But again, so I think there is room for to kind of exploit that by just spending more time in developing foresight, right? And I think there's a profound lack of foresight right now because, like I said, there is a lot of information out there, and everybody's reacting to the same data. Media, as you said, narrative media plays a massive role, and you have retail. Right now, everybody's got access to their apps on their phone, and they could just react to news and just make investment decisions. So it really leaves room for long-term investment opportunities. But in the short term, the short-termism of not performing like the crowd is becoming problematic. And I think that's where you really need to understand your clients, and clients need to understand you and your investment philosophy and process.
Is it fair to say that there's somewhat of a pendulum that swings between art and science in the market, because for a few years we saw a huge amount of quant funds kicking off and they were doing extremely well. In the past probably 2 years, these quant funds have really struggled, or at least when you look at
Yeah.
the median results, there's still some dispersion there, but the vast majority have really done poorly compared to what they've done historically. Is this
Yeah.
part of now the market becoming too quantified that it's actually almost falling over and there's too much crowding on particular types of strategies?
I think so, Alex. I think that there is a lot of that. There's a lot of crowding, the quantitative. So in the past, remember how we all started with the real advantage was this, we call it the high frequency trading, and you algo. So the arms race was to get the closest you can to the exchange or have the fastest computer so you can actually trade very quickly. So that was the game. And a lot of those guys made money. And then when the whole thing, everybody had access to fast computers and everybody did the same thing, that particular strategy started to struggle. So then they moved to more of a quantitative trading or factor investing, what have you. Well, so initially, we've seen a lot of the back test of those factor investing. Historically, there's premium in every one of those factors. But when we do, there's a catch-22. When we measure those premiums, is when, it's just when they were measured. The act of measuring something impacts how it performs in the future, right? So what happens is everybody has got access to factors, right? Whereas before we would just did back tests and they worked because no one else was actually following it. Now everyone's following them. Everyone's got access to it. Those quantitative factors, quantitative models are just crowded, as you said. And when everybody starts to do the same thing, we say when smart beta becomes dumb beta, right? Because everybody's doing it. And again, and so like you said, though, the pendulum, swings. I agree, because I remember the quantitative investing became such a big thing again in, remember, 2006 before, and we had the quant quake, we had the VAR shock and what have you before the GFC. They were quite big. So it just those quantitative models really suffer from the profound, call it a model problem, which means, the individually, when they look at things going wrong, the probability of that's not very high. When the things go wrong and cascade, they impact each other. And then when everybody's in the same idea, it impacts them all. And I'll call that a model risk. And that's what quant funds. And so when the space gets emptied again, froth comes out, then there's room to do it again. But you're right. It just goes, the pendulum swings from, very crowded to just all of them being out.
Is there another problem that when you talk about model bias, that actually you've got this institutional investor bias where the structure of these funds is all becoming the same, the way they go through their investment process is the same, the type of rebalancing is the same, the way they use their VAR models and risk models is the same, that ultimately you're creating this homogenous group, and they're so large that it's moving the market in very large ways.
Absolutely. And that's the thing. We saw that, we saw that in 2006, the VAR shock that we saw. Everybody is in the same thing. They measured risk the same way. Volatility is low. Everyone's positioned the same way. And when things move, it just becomes self-fulfilling, right? And I think it's becoming a little bit worse now because, a lot of those value managers have gone out of business, right? So in the past, you had this cohort of managers where just when things sell off, there'll be buyers on the other side because not everyone is a systematic trader or passive investor or benchmark investor. So you had some automatic stabilizers. Now a lot of those active managers you've seen, they've just been out of business. Active strategies have underperformed. I'm not saying it's all doom and gloom and it's bad. I think there's still a lot of stabilizers in the system. But as you said, the risk is everybody's doing the same thing, and then the risk is if it unwinds, it can unwind very quickly. There was a real threat of that during the COVID pandemic, and if it wasn't because central banks and governments really getting out there and just acting as circuit breakers, it could have gone out of control. And the good news was they could do it because at the time there was no moral hazard, right? So because there was nobody's fault, they could do whatever it takes. But if it happens because of a blow up in a fund and cascades, then the moral hazard is a lot higher. And then I don't think the central banks governments will be able to come out and do what they did during COVID.
I'm interested in the whole moral hazard problem because we've actually seen probably 3 very large blowups in probably the last 12 months. Melbourne Capital, Green Sills, and then most recently we've got Archegos. And I guess many people are wondering, why are these guys blowing up at a time when the markets are at record highs?
Yeah. Well, that's I mean, the amount of greed and leverage in the system is huge. Right. So fortunately, what happened to some of those funds, it really didn't have this kind of a systemic impact on the broader market. But that's the thing, market, you gain these blow-ups because of you've seen the games that are being played in the short squeeze versus a short covering, short squeeze, and so all these different games played with leverage. Right, with a lot of leverage, and that's the thing. So you just had to blow up because one position. There is not much room for error, right? So that's the thing usually, and that's a great sign of speculation. Usually happens at peaks, right? And that usually what pricks that bubble is central banks tightening. This time we don't have that, and central banks have told us they're not going to raise rates. So we're gonna get this isolated blow-ups here and there because money is cheap, right? And the trend is up. And so it just encourages a lot of greed and leverage we've seen. But it's just one of those things. You can make a lot of money, but you could just lose a lot more than that.
Well, the other challenge that many of these funds have is that it's not just the leverage, but they're becoming very concentrated on their bets. And they're also moving into areas that are probably not liquid. And the illiquidity problem starts to come to vogue, particularly when they need to unwind these trades. Because of the homogenous group of buyers and sellers, it's very hard to be able to get out of these trades.
You're right. I mean, there's some really small stocks that we've seen in areas that, they're heavy short positions and everybody's in the same position. And then everyone tries to cover at the same time. There is not enough liquidity and you get this kind of fund blowups. I kind of don't think this is a big, broad systemic problem. There are some smaller funds that have these big bets in small areas, and we're going to see more of those things. We're going to see more blow-ups. But I think that in a big picture, the big money is in areas where it has benefited from falling bond yields for 40 years, right? So that is the part that everybody is exposed. And I don't think that will be an accident waiting to happen. I think that will be a slow bleed. Right? We've had 40 years of falling bond yields benefit. Nobody can imagine anything different, right? And all the portfolios, global funds, you go measure duration in portfolios of clients and institutions, just global portfolios. I think it's not an unreasonable assumption to say, the duration exposure is, in funds is the highest it's ever been. So you have very high duration. And by duration, I mean allocation to private assets, right? Allocation to growth equities, which are, long duration growth stocks. They're very heavy in benchmarks now, so benefited from falling bond yields. And obviously allocation to all the bonds, right? So the duration exposure is so high at the time that most likely we've seen the low in bond yields. I mean, obviously, we've said we've seen the low in bond yields many times and it hasn't happened. But clearly, this time seems to be different. And I was saying, very different to what we have. I'm sure we discussed that later. But there's a lot of things that makes this turn different to what we've seen in the past at least 20 years. So, and that's where everybody's positioned, right? So that's if we see a massive spike in bond yields all of a sudden, then that would be just really painful. That if you get forced exit in some of those private assets, that would be painful. I don't think that's possible to get a sudden spike in bond yields. But like I said, I think that would be a slow bleed and underperformance. When it comes to those greed and leverage and being in small stocks and low liquidity things that people need to get out in a hurry, I think that's not big enough substitute market to pose a systemic risk right now.
But what happens in this marketplace where we've just got such large asset owners in the world, whether it be super funds or endowments and so forth? They're so large, they don't really have such a flexibility to be active. And ultimately, they become long duration holders of assets. They don't
Yeah,
really have
yeah,
the flexibility, particularly when
yeah.
you become a 200 or $300 billion fund.
It's very difficult. Exactly right. And gets even worse when we have the government sitting just saying we're going to measure your performance every month, every 3 months, and put it in papers. And if you underperform, you'll be, some of the short-term performance measures that they've been put against some of those funds. It's hard because then everybody will be kind of scared to take big deviations, right? Or be ahead because you got to go onto the music plays and then So and then you don't have not only you don't have the flexibility because you're too big, as you said, but also from a career risk point of view, you don't have the appetite. So again, that becomes that becomes a slow bleed because you can't move quick enough to those things. And the good news is there's a lot of good performance buffer for some of those funds because you benefit from 10 years. But for somebody who comes in now, the next 10 years will be very challenging because, as you said, there's not enough flexibility to shift exposure to areas that benefit maybe when interest rates go up or bonds go up or inflation goes up. Long duration assets, very, very sticky, hard to get out. I mean, we say these assets are long term, we don't care as long as we get the income. But we've had the benefit of getting income as well as capital gain. We haven't really seen a period that we get the income, but with bond yields going up, those valuation of those assets will be challenged. And that will be very, very slow to respond. Again, so I don't think there's going to be a force to exit. All of a sudden, everyone is trying to get out, but underperformance and slow bleed, it's going to go for a while, and it's tough. And I think it would take after 5 years into it, then people start thinking about, okay, well, we got to do something about it, right? And the thing is, when we are so peer measured, the ability to think the future and ability to have foresight is very low. And to your point, it's going to be tough.
What does that mean then from portfolio construction perspective? Does that mean that funds need to totally disband in the 60/40 and really think about how to build a portfolio of almost different types of strategies, in one? How does that change?
Absolutely, that would be the way to go, but it would be very hard to encourage that, right? So imagine trying to go to super funds and say, encourage that just abandon 60/40, right? It's impossible because what happens if you're wrong for 1 year, right? Then you just, the thing is one of those things that, you can't just, ring the bell and say, this is the time, but structurally, directionally where things are going, but there's no appetite to be wrong, even for 6 months. So which means, just breaking that 60/40 and then changing the structure to invest across different sectors even, right? Or at least, diversify your position across areas that actually benefit from rising bond yields and areas market that actually probably have negative impact of, we feel that, will be negatively impacted. So that requires big changes. I don't think there will be appetite for it, but you're right. Ideally, that's what, you got to break down the 60/40. First of all, I think every one of those funds, they really should go and they just take a good look at the allocations and look at the duration exposure, right? Duration exposure, you look at the duration through your allocation to global equities, which is a lot of it is tech stocks now. Even emerging market equities, a lot of it is tech stocks, right? And tech stocks, by definition, they're all really long duration stocks, subject to massive regulation risk. Put that aside as well. And then the allocation to all the private markets and bonds. You just measure the duration of your portfolio and then compare it against history and see how high it is. And you put that against where yields are right now. That massive gap that we have, high duration, very low bond yields, if that gap starts to just slowly converge and close, that will be a pain. That will be just a pain. And I think you're just going to see how you address that high duration with low yield. So, and start introducing asset classes of portfolio that benefit from rising bond yields, right? Or I think the other group just are convinced that bond yields would never go anywhere because there's too much debt in the system, nothing's going to change, and we're going to have a little bit of inflation and we're back to deflation. Well, that's a call they got to make. But I think if you do the numbers, chances of seeing at least 5-6 years of high bond yields and high inflation is very high, and portfolio construction needs to change.
The biggest question then is really, where does inflation go? And I guess anecdotally, when you look at stock prices, or you look at collectibles, or you look at houses, inflation seems to be pretty rampant. On the CPI numbers, it looks pretty flat. At what point does the market start to, factor in that inflation is rising and that the central bank will need to do something?
Yeah, absolutely. As one of those things, when you look at the fixed income market, inflation expectations have been going up, but definitely not in line with what we're seeing in in prices or asset price inflation. But that has been the problem for the past 10, 20 years, right? We've had asset price inflation without really CPI increase, and so every time central banks have hiked rates, it's led to another bout of deflation, right? So, but then I think when you look at the drivers of that disinflation over the past 10 years, you can just sort of say globalization and demography play the key role, right? And on that one, you first look at China. China, from the 1990s to now, China had a massive impact on global supply of labor, right? When you have a massive supply of labor, so you have all the production globally shifted to China, right? Chinese pays, obviously labor was cheap. And at the same time, in the developed world, everything's going, all the investment, there's a push to services. So you have this massive disinflation force played by China. If you, over 20 years ago, the wage ratio between US and China, it was somewhere like the US to China was about 30 to 1. Now it's about 5 to 1. You can see that a lot of that is being played. China is not cheap anymore. On the top of that, you have COVID and shorter supply chains, right? So that's the impact of China, which was, I think the impact of China on global disinflation was profound, and that's reversing. On the other side, you have the demography, right? If you look at the age of, dependency ratio, some of the working age population in the US, or just the baby boomers, are just moving to retirement, right? Which means you're going to get the supply labor is actually coming down. So people in the working age population coming down. So you are at a point that there is no more need for investment, but at the same time, there's less supply. So that is on the structural changes there. And then on the top of that, you have the central bank, as you said, the Fed. They have moved from modeled inflation target to ex post. So, and you can see their determination to end deflation is exact mirror image of what it was in the late 70s. I remember a reading, I wasn't in the market in the late 70s, but Paul Volcker started talking about breaking the back of inflation in October 1979. And they went serious to change it. That was the thing. But it took a year or two before the bond market started believing it. Right? Initially, bond yields ran up from 16 to 20 or so percent. So the bond market didn't believe it. But when their determination was to break inflation, they did it. And the thing is, it went on, and then it corresponded with the rise of China and all that. So it led to this massive disinflation or deflationary period. A lot of those factors, a lot of those drivers are reversing now. Central banks are just adamant to get inflation. We are seeing quite a great demographic reversal, and the rise of China in terms of production on investment, or what we've seen in terms of capital going to investment and the labor force of China, it has reversed. I mean, over the past 20 years, we've seen China's labor had introduced or added 120% to global supply labor. That trend is not going to continue. So I think structurally, we've gone through the period of that disinflation, and next one, structurally, we are on the upside. But, the path from deflation to inflation, there's always a reflation period in between. I think a lot of people are just looking at, they're looking at this binary thing, deflation, inflation. Oh, no, there won't be inflation, so we're going to stick with deflation. But I think that just misses the point that before you get to inflation, you're going to have reflation. You're going to be able to run global growth at a very high levels for so many years before you can get the overheating to lead to inflation. And I think that's the story with next 2-3 years when we have reflation and rising bond yields. The inflation will come later, and that will be priced in. I think that's the direction things are going.
Is it likely that you can potentially have inflation on just general goods and services, and at the same time, the demographics is a real negative drag on asset price returns as many people try to withdraw their superannuation from the system?
That's a good point. That's a good point. That's a possibility. I mean, just these guys you need, but I think the offset against that is the growth part. So there will be pressure on asset prices at the again, like you said. People reach retirement age and they need to disinvest. But on the offset of that is that much stronger growth. Growth is going to be run hot, so they don't get central banks cutting it short this time, right? But Fed starting the Fed and the rest of the world, even in EM. So I think the offset against that asset price sales, the pressure on asset prices, is the fact that global growth will be stronger. So that means, there will be some assets will be impacted, right? So I think the leadership, market leadership, what assets perform will be very different to what assets performed in the past 10 years, right? Because then it will be essentially to bonds. But great point. There will be push towards disinvesting, selling down. But yeah, there will be offset against much stronger growth and stronger productivity that we've seen. We've seen technology, over the past how many years, tech has been all about Netflix and Apple and some of those things. We can waste more time on social media. But you can look at it now, how technology has truly been engraved in every industry now. Every industry is tech sector now. Mining itself, right? So there's matter of technology being utilized in every industry is just huge. I mean, coming out of COVID, those companies have a massive operating leverage to using that technology to make money, and also being able to generate strong growth. So it will be an interesting next 5 years. Surely it will be very different to what we had over the past 5 years.
Well, it sounds like you're pretty positive about active management, right? You've talked a little bit about the challenges of trading in a market that can be highly inefficient. For a fund, a super fund, for example, their challenge is how to work out where to spend their fee budget. Where do you think the most opportunity for active management then lies? Is it around thinking about the strategies you put together, thinking about the individual companies you put together? Is it around building more sort of option style payoff strategies? What's the likelihood of success of active management look like?
Yeah, it's a combination of that, Alex. I think you first of all, with active management, you need to have less constraints, and the strategy, whether it be stock picking or be top down investing, but then also execution, smart execution. You can have really good ideas, but if you execute it poorly, then it doesn't end in results. So having these options, having different ways to execute an idea is very important. I think investment houses or asset owners need to develop expertise in execution, right? And then also, on the strategy side, active management. I think a lot of the fee budget on active management obviously is all gone to private assets. When it comes to public markets have been really just it's either in passive or quasi-passive, right? And when the allocation you have to active strategies, they all have tracking around MSCI. It hardly makes difference if you are 2% underweight something or 5% underweight, right? I think you're just going to have to go towards more an absolute return strategies, right? But clearly understanding the investment process and philosophy of those strategies to be able to make a difference, right? There are some areas that active management is not worthwhile playing in large cap stocks. Maybe start using that fee budget towards some of this absolute return. I firmly believe if you're going to make a difference, you're going to be more absolute return, goals based absolute return, as opposed to when you're an active manager with a 3-4% tracking error against the benchmark, you might as well be on ETF. Release that fee budget to put it in absolute return strategies where you actually, you can play the themes, obviously in a risk controlled manner. And so again, so to answer your question, I think a lot focus on absolute return strategies, but with also execution, very smart execution, because that makes all the difference.
One theme that's been really popular of late is this green revolution theme, ESG, SDGs. That's one side. On the other side is the anti-ESG portfolio, and trying to take advantage of the imbalances that some of this wave of money is actually creating. How do you think about that as an opportunity, and how can you potentially still play it as an active investor?
First of all, that the green revolution is huge and is here to stay, right? So we're gonna see more and more things being run on batteries for the next 10 years, right? So there is going to be a massive push towards batteries or other alternative sources of energy like geothermal and what have you, right? But at the same time, because of the vested interest in our industry, there's a lot of people just piggyback on those revolutions to just make some quick money. You go look at some of those ETFs that have been provided, right? And you look at I was looking at, I don't want to name, but you could look at the ESG ones, right? Compare the ESG ETFs that they provide versus the normal ETF, right? And you look at the amount of Apples and Amazons and all those in it, right? It's very similar, right? So they charge about 3 times the fee, but for a portfolio it's got maybe a little bit more Apple, a little bit less Apple, which is, it's crazy. I mean, that's not what ESG is about. So I think there's a lot of greenwashing going on in the market, and I think this is an unfortunate reality of our space, our industry, where people just want to come in and skim. That's just quite sad. But I think when you come to the green revolution, you just look at the batteries, like playing. You look at what goes. I mean, the push towards batteries, it's going to be pushed towards high density batteries. Batteries, we can store a lot of energy, right? And what do you need to material? The thing, what those batteries all need minerals, material, right? Everyone is happy to go and buy those loss-making solar companies. Just keep buying it and speculate on those. But you look at what actually is used to make those batteries is minerals, right? Nickel, platinum, platinum, some of those rare earth metals. I think that is a super theme to play. And that's the thing. We've had a super commodity super cycle. The first one was the rise of China, which obviously a lot of it was fossil fuels and coal, right? This one isn't China. This is about green revolution and energy transition. Energy transition is the required amount of metals to build those batteries and solar panels and wind turbines and what have it be huge. And there hasn't really been much production in those areas. There hasn't been really research and development. And that's to me, that's the way to play it, as opposed to go and speculate on the company that makes the next solar battery. And that is the growth part. I mean, some solid companies that make batteries, and the ones that actually have partnership with auto companies, that make sense. But I think playing it through metals makes more sense. But I think it's just, you look at through some of this greenwashing that's going on. It's sad.
But it's quite funny because everyone talks about being net carbon by this date and by that date. And ultimately, when you start going down the mining place, there's a lot of carbon involved in this process, right? It's not the most energy friendly or environmentally friendly.
Absolutely. I mean, we don't have enough alternative sources of energy to use that to make more alternative energy. You got to start with what we have, which is a lot of fossil fuels. And I think there will be better ways to use that energy. Maybe natural gas will be kind of a green energy choice for now until we have be more sustainable energy. But you're right, to be able to generate that batteries, you need energy to spend energy, right? And not only we're not just reducing the use of energy, we're using more. And then we add that Bitcoin to it and look at the sort of use of energy. Just imagine if Bitcoin just becomes more broad-based use, and I think that's just going to that's going to undo a lot of what we've done when it comes to neutralizing carbon dioxide.
Maybe that's a good place to finish off the conversation. Cryptocurrencies, your thoughts?
Yeah, well, when you say cryptocurrencies, blockchain, that is true, right? So digital currency is going to come. But I think when it comes to this unregulated Bitcoin, there's a lot more at stake for governments to let that happen. They will regulate it. Obviously, Bitcoin and what have you, they will be used by people who just want to shift money around without anyone knowing, right? So there is groups that always will want to use Bitcoin, money laundering, what have you. But it's not the direction the world is going. Bitcoin, like I said, it just adds a lot more to pollution. Its carbon footprint is huge, right? And to me, I think Bitcoin, it's just one of those, we have populism in politics, but there's a populism in financial markets too. So you just can't just tell a whole bunch of young generations, oh, you don't have enough money. Central banks are just destroying the value of your money. You can't buy a house, you can't buy assets because, because it's all rich people, inequality, everyone's got it. But you can get a piece of action by Bitcoin, right? And then everyone believes it and say, yeah, this is how I get mine, right? And everyone makes money. It feels good. So you see, I've got my share of the thing. It's a populism, but it's just in the form in financial markets. And people are fanning it. There are some rich people that can, they can, fan fuel the fire. But at the end of the day, the direction, from an energy use and carbon footprint, Bitcoin is not the direction the world's going. So it's not. I don't think that would be the currency of choice. And it's hollow. It's empty. It's based on nothing.
So we should be thinking of gold potentially then as being a true asset of rather than being this crypto gold, we've actually got real gold.
I think so. That's still a real store of value, and it's got industrial use as well.
All right, this has been a fantastic conversation. Thank you very much for your time today, Nader.
Thank you for having me.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.